70 cents. That is what your Canadian dollar is worth against the American one right now. And if you have a trip booked south of the border this summer, or a single grocery item that started its life in the United States, you already feel it. A couple of weeks ago, the loonie slid to about 70 US cents, roughly $1.42, to buy one greenback. That is the weakest it has been in 14 months since the early weeks of Donald Trump's trade war. It did not get there overnight, and it did not get there by accident. Part of this is a story about the American dollar getting stronger against almost everybody, and I will be honest with you about that. But part of this is a set of choices made right here at home. And there is one number buried in the reason that even a lot of people following this story have not clocked yet. The people who feel the weak loonie first are never the currency traders on Bay Street. It is the family already doing the math at the checkout. And how your dollar quietly lost this much of its value comes down to a decision most people never heard get made. Here's the version of the story that's been going around, and I want to be straight about where it is right and where it goes off the rails, because that is the whole game with currency headlines. You may have seen it framed like this: the loonie has collapsed into the weakest reserve currency in the world, and there is a real credible source underneath that. National Bank, one of Canada's own big banks, wrote in its June currency note that the loonie had been, quote, the weakest reserve currency in the recent weeks, end quote. That is a real line from a real Canadian institution, and the currency really has been getting beaten up. So far, so fair. But watch what happens to that sentence when the qualifier gets quietly deleted. Weakest reserve currency in recent weeks means it was the worst performer of the group over a short stretch. Weakest reserve currency in the world means Canada's dollar has fallen to the bottom of the pile, and that part is simply not true. The International Monetary Fund tracks exactly this. As of the most recent count, the Canadian dollar is about 2.5% of the world's official reserves. That makes it the fifth most held reserve currency on Earth, ahead of the Australian dollar, ahead of China's yen, ahead of Swiss franc, and its share has actually been holding up as central banks look for alternatives to the greenback. So, no, the loonie is not the world's weakest reserve currency, and anyone telling you it is selling you a scarier story than the facts support. Here is why I bother correcting it instead of just running with the scary version. The real story is the more useful one, and it should still worry you. Strip the hype, and what National Bank is really saying is that over these recent weeks, of all the major currencies a central bank might hold, ours is the one that has been sliding the hardest. That is not nothing. A currency that is merely small is fine. A currency that is the worst performer in its weight class and grinding to a 14-month low while it does it is telling you something specific about where money thinks this country is heading. And the reason it is sliding is not some mystery of the markets. It traces back to a decision and to a gap between two numbers that has been widening for months. That gap is the thing almost nobody is putting on screen. Remember that decision I said this traces back to? Here it is. Over the past year, as both Canada and the United States started cutting interest rates down from their inflation-fighting highs, the Bank of Canada moved first, and it moved further. The U.S. Federal Reserve held back. On paper, that sounds almost responsible. Our economy was weaker, growth was soft, so the Bank of Canada gave it more help, faster. A reasonable person could nod at that. But here's the actual number that decision produced, and it is the one to hang on to. The gap between Canadian and American interest rates has widened to somewhere between 1 1/4 and 1 1/2 percentage points, with U.S. rates sitting higher. Let me say what that gap does in plain terms, because this is the whole engine. When American bonds pay more than Canadian ones for the same safety, big money sells Canadian dollars to go buy American ones. None of that is a sentiment. It is simply where the better risk-free return sits. Every basis point of that gap is a small current pulling money south, and right now the current is strong, and it's about to get stronger, which is the part that turns a bad month into a trend. Markets are not betting the Fed cuts next. They are pricing in the Fed possibly raising rates once or twice more by the end of this year, while the Bank of Canada is stuck holding. If that happens, the gap does not close. It widens, which is why the loonie did not just dip. It ground down to about 70 cents, a 14-month low, and forecasters are now openly floating 65 cents US as a real possibility. Stop and sit with that for 1 second. 65 cents on a currency that bought 74 cents in January. Now, I promise to be fair, and here is the fair part said plainly. A big share of this is not about us at all. The US dollar has been, in one strategist's words, crushing all of its global rivals, pulling money out of every economy and into an American boom, and ours is caught in that tide with everyone else's. but a tide lifts and drops every boat the same. It does not explain why ours has been the worst performer in its class. That part is homegrown. It is a weak growth economy and a trade war still not settled. And the trade file, at least, is squarely something Ottawa can move and so far has not. So what does a 70-cent dollar actually cost the family that never reads the currency page? That is where this stops being a market story. So put it together. The scary headline is wrong, but the real story underneath it is worse than boring. Our dollar is the weakest performer in its class. It is at a 14-month low, and the main homegrown reason is a rate gap set to widen, not closed. Up to a point, a soft loonie is an abstraction, a number scrolling on a screen you do not watch. Then it crosses into your actual life, and here is where that line sits. Start with the checkout, because that is the first place it lands. Canada imports an enormous amount of what it eats and buys from the United States, and every one of those things is now priced in a dollar that buys 70 American cents instead of 74. The Bank of Canada's own governor, Tiff Macklem, has already flagged that inflation ticket back up, with food a specific concern and prices running above 3% again. A weaker loonie pours fuel on exactly that fire, because the strawberries in January, the online order from a US site, the part your mechanic has to bring across the border, all of it costs more in loonies the lower the loonie goes. That is rung one, and you are already paying it. Rung two is the trip and the big ticket stuff. If your family had a summer trip booked to the United States, your money there buys about 5% less than it did in January. A nickel off every dollar gone. Same hotel, same rental car, more loonies out of your account. Now run that same math on anything bigger. At our agency, Smart Retirement, we work with seniors and families every day. And we see how much of what fills a household's life, especially those planning their retirement budget, is priced off a US dollar one way or another. When the loonie drops, that is a quiet raise for every American seller and a quiet pay cut for every Canadian buyer, and nobody sent you a memo about it. Rung 3 is the one that has not fully hit yet. National Bank's own note says a real recovery for the loonie will likely require Ottawa to land a trade deal with the United States this summer. Read that carefully. The bank is saying the currency is now partly hostage to a negotiation that, as of right now, is not done. If that deal slips, the tide of the US dollar strength keeps pulling, the rate gaps keeps pulling, and the floor people are quietly modeling is not 70 cents, it's 65. Ask yourself what another nickel off your dollar does to a grocery bill that is already climbing. And there's one more piece to this that decides whether 70 cents is the bottom or just a stop on the way down. That one more piece is a choice, and it is not yours or mine to make. It belongs to the government negotiating that trade deal and to a central bank deciding whether to keep sitting still while the Fed leans the other way. Get those right, and the loonie claws back toward the dollar 1.35 that National Bank still pencils in for year end. Get them wrong and 65 cents stops being a forecast. Here is what the record actually says underneath the hype and the panic booth. The loonie is not the weakest reserve currency in the world. That part is a myth, and you should not repeat it. But it has been the weakest performer of the bunch. It is at a 14-month low, and the biggest reason we can actually control is a widening rate gap and a trade file Ottawa has not closed. Those are decisions, not weather. And remember where we started, with 70 cents at the checkout. That's not an abstraction on a screen. That is the raise you did not get showing up in the price of everything you buy from across the border. We cannot move. A strong country usually has a currency the world still wants to hold. We have that. What we do not have right now is a government acting like it wants to keep it.